Australian government is now reducing its guarantee on bank deposits to $250,000. That's kicking in from today. The permanent deposit guarantee scheme replacing the emergency scheme, which covered deposits up to $1 million, and that was introduced in 2008 at the height of the global financial crisis. Well, Dr. Stephen Nash from FIIG Securities is with us now from Sydney. Mark Todd, no less, correct on that one. Mark, welcome to the show.
The younger version.
The younger version. You're too kind of your colleague. Listen, on that very basis, and a question of timing first off, Mark, what do you make of it? What's triggered this move? Or was it simply diaried and now the time is nigh?
Yeah, I think it was just diaried. I think they took a lot of consultation. They had a lot of people who were involved in this process, from the Fed, from all the banks, all the various ADIs. Everyone spoke to the point. And it came in at $250,000, and so they had to set a date, and they chose February the 1st, and there was a transition period, if you like. So existing term deposits were able to reap the $1 million benefit, and then as they rolled over from September, when the announcement came through, it was then compliant to be $250,000. So all the lobby groups got involved, advocates as well. So I think it's not a shock to anyone. Everyone was preparing for it. It's just one of those things where you see the policy, you're waiting for the actual reaction by the clients.
The idea of permanency, though, and government oversight, how does that really sit alongside Australia's AAA credit rating and all that?
Well, I suppose I actually like the idea of it. I think in the US they've got the similar sort of policy around. And so when you have an industry that has been regulated by APRA in the manner that it is, I think it's safe for the government to say it makes sense to have an insurance scheme and have a regulator that makes the insurance scheme compliant. So to the government's idea, you want to have vibrancy in your banking sector, and to the point of one of your previous stories where people are complaining and creating class actions against the four majors, it's incumbent on the government to make sure that there's commercial pressure. And as small as it is, there is commercial pressure on the four majors to, be reactive to the market demands.
What does it do to risk in this environment, though? Does it further drive another nail in the coffin of that? It just sends a signal that, if you want to move, you're going to have to clear it with X, Y, and Z, and that's hardly free markets.
I'm not sure what you mean by that. In terms of the risk reaction, I think what it's doing is identifying the fact to the investor that the Australian banking system is very stable and very safe, and the government is saying we're prepared to put our insurance guarantee scheme around what we understand the banking sector to be. So a lot of the times, if you were dealing with the teachers' credit union and you were in another part of the country that wasn't familiar with it, you'd need to have some sort of comfort around that $3.5 billion entity, and it makes sense to be able to say, the Australian, the Australian industry, the Australian industry is much more vibrant than all the normal investors are aware of.
Well, for bond investors in particular,
sure.
What are their options?
At the moment, it's a varied piece, isn't it? We see a lot of this covered bond talk. It's over $6 billion from two issuers, and we imagine there'll be more of it. So if you see in terms of the highest quality rating, we've got the term deposits and the covered bonds, and then you can move into the range of hybrids, which will be, as an example for your clients, your viewers, they'll know Origin, they'll know Woolworths. That's the range, and within that range you'll have senior debt, you'll have subordinated debt, and you'll have Tier 1 capital. So you have a very broad range of assets now that are becoming part of the vernacular. All the time we see it now in the press, whether it be a covered bond story or a term deposit or a hybrid. So there's a lot of options for the investors at the moment.
Well, the very ranking behind you, where you're standing, your decision to rank corporate bonds first off, I mean, just explain that. I'm just looking at the signage behind you now. I mean, in terms of a client preference.
Yeah, so I think, Carson, one of the raison d'etre, if you like, of what we are at FIIG is that we're experts in that. We are specialists in the corporate bond world and the term deposit world. When we've got over $6 billion in term deposits, and we do an awful lot of activity in the corporate bonds. So that's where we've seen our niche, our speciality. We've got the biggest sales team in Australia for corporate bonds. Whereas if you're looking at generic Australian government debt, you might go to go to the reserve. You know, if you want to be part of the broad distribution of, you know, a hybrid stock, you'll get it from stockbrokers. But we see the speciality that we've got is identifying the credit and talking to our clients who, over the last, you know, 4 or 5 years, have become much more sophisticated in the ideas of credit. So, you know, do I buy an Origin hybrid, or can I buy the physical asset, the underlying corporate bond, at the same or comparable yields? So it's just a question of where we see our skill set.
It's the extent of the offerings, though, for mum and dad investors, though, more than anything. How do you kind of tap that space?
I mean, what we are is very rigorous around that in terms of the actual issuance itself. We're always talking to, on the origination piece, to ask customers to issuers to create assets that are available to the retail market, or the self-managed super funds. So the high net worth, the people that have got that money to disperse. We're not really looking for the mums and dads that have got $10,000 to invest, because they need to be able to go to their financial advisor and get the appropriate advice for them. But in terms of the trading mentality in that big sector of the market, which is self-managed super funds, we're just providing some balance towards the equity piece that they're investing in. If they do 50% in equity and 50% in debt, that makes a lot of sense to us. So we spend a lot of time with the research people going through the various assets that might be, let's say, a NAB cap. You know, so a funding bond for the National Australia Bank that might be trading at 330 over the cash rate, the prevailing cash rate. It's a very stable asset, and it's something that might be appropriate for the right type of investor. So, you know, they get their financial advice and we provide the potential assets for them.
There you have it, and succinctly put, Mark. Thank you so much.
Take care,
as
mate.
always. Mark Todd from FIIG Securities.